Welcome to this episode of our 3-Minute Investment. We help you easily understand the financial reports of popular companies. The economy has been a roller coaster: inflation, interest rates, and uncertainty. But amidst the noise, one financial giant just delivered a clear signal. Today, we're breaking down Bank of America's 2025 performance and what it means for your wallet. First, the headline number. Bank of America earned over $30 billion in 2025. That's a 13% jump from last year. How? By navigating a soft landing, cooling down inflation without crashing the economy. As rates stabilized, the bank maximized earnings while keeping costs in check. The engine behind this growth is net interest income. Think of this as the bank's paycheck. It's the difference between interest they earn on loans versus what they pay depositors. In 2025, thanks to higher rates and smart management, this paycheck grew to nearly $16 billion in just the last 3 months of the year. But it's not just about interest rates. It's about technology. Bank of America has built a digital moat. They spend $13 billion a year on tech, so 59 million of us can bank from our phones. Every time you ask Erica a question, and she's answered 3 billion of them, it saves the bank money. This efficiency is why their profits are growing faster than their expenses. CEO Brian Moynihan calls this responsible growth. It means growing without taking reckless risks. In 2025, their trading division had 0 days of losses. That's rare. It shows they are prioritizing safety and stability, acting as a fortress even when the market gets shaky. Running a massive bank costs money, but Bank of America is getting leaner. Their, quote, efficiency ratio of 62% simply means for every dollar of revenue they earn, they only spend 62 cents to keep the lights on. This gap is widening because their income is growing faster than their bills, a financial sweet spot investors call positive operating leverage. So what do they do with all that leftover profit? In just 3 months, they handed $8.4 billion back to their shareholders through cash dividends and buying back their own stock. They did this while keeping their CET1 ratio at 11.4%. Think of this as a massive, mandatory emergency savings account that ensures the bank remains safe during tough times. The foundation of this financial machine is customer trust. They hold over $2 trillion in deposits, ranking them number 1 in the country. In uncertain economic times, people tend to move their money to the biggest, safest banks, a trend known as a flight to quality, which gives Bank of America a huge pool of low-cost cash to lend out. It's not just checking accounts. They oversee a staggering $4.8 trillion for wealthy clients. As older generations pass trillions of dollars down to younger ones, an event known as the Great Wealth Transfer, Bank of America is capturing those assets, allowing them to earn steady management fees regardless of what the stock market does day to day. But are people actually paying back their loans? The answer is yes. Their net charge-off rate, which is the percentage of loans the bank gives up on collecting, is a tiny 0.44%. This extremely low number proves they lend primarily to customers with high credit scores, keeping their risk of actual losses incredibly low. All these numbers boil down to one key metric: Return on Tangible Common Equity, or ROTCE. At 14%, this measures the actual profit generated on the money shareholders have invested in the company. Since this 14% return is significantly higher than the cost of getting that capital, they are actively creating real value for every share you own. Looking ahead to 2026, the bank expects their main income engine, net interest income, to grow another 5 to 7%. This is largely due to asset repricing. This means as old loans with low interest rates expire, they are replaced with new loans at today's higher rates, automatically boosting the bank's paycheck without them having to do extra work. It isn't all smooth sailing, however. There are risks to watch. New government rules known as Basel III might force banks to lock up even more cash in reserves, which limits how much they can invest. Additionally, the commercial real estate sector remains shaky, though Bank of America's exposure to risky office buildings is actually quite small compared to their total size. In summary, Bank of America offers a rare blend of safety and growth. They dominate the digital banking space, their loan book is incredibly healthy, and they are a cash-generating machine. For investors who don't want to constantly worry about their portfolio, it represents financial resilience in a changing economy. Thank you for watching. Let us know what companies you want to know more about in the comment below. Please subscribe for more financial analysis to rocket your investment.